So now let's talk about retirement. Okay? So you've made the money. Now you start thinking about how do you put the money aside for retirement. When is retirement? Retirement, according to the laws of Kenya, is what age?
50, 60.
Is it 60? They keep moving. You 55, 60, 60, 55, 60, 65. It is 60, right? 60 retired. I'm looking at you, CT.
I know you're looking at me.
That does not mean...
Odundo was looking at me earlier on.
But you're not, are you 60? You're not 60.
Let me just tell you this thing. All you need to do to get to 60 is to stay alive.
If you stay alive, you're going to get there.
You'll get there, yes.
Yeah.
That's all you need to do.
That's all you need to do.
Okay.
Yes.
There are people who retire at 70, at 80. Retirement is a matter of choice. The law be damned. And then there are people who retire even at 40 and younger.
Yep.
And others, like Jeff, our next guest, why do I have to wait until I get to 60 to say that I've retired?
Sure.
Right? I can retire, but that doesn't mean that, I am no longer, I am
bound.
I am incapacitated.
No.
Retirement is one thing.
I can unretire.
Yes.
Yeah.
And so Geoffrey Odundo, who is a group advisor at CPF, is here, executive advisor at CPF, is here to teach us about retirement.
Yes.
And to tell us about the journey to retirement. Karibu sana, Geoffrey.
Oh, thank you very much, Latiff. I think it's great to be here. Really long to come here.
What do you mean you've longed to come here?
Yeah, I've been waiting
We've
for the
asked
invite.
you to come here, but you were too busy.
Yes,
running the Securities Exchange.
Yeah, certainly. Well, you asked a very good question about what is retirement. So retirement is ideally when, it's more like a second phase of life. You're trying to sort of transition from a formal working environment into more relaxed life, so to speak. But nowadays I never see retirement. I see old age living. So ideally, the standard structure of a work life is that you spend the early part of your life, the first 50 to 60 years, building a career, investing, creating a family, and trying to save for the future. The second half of your life, you now want to enjoy what you built over the first half of your life.
Yes.
And that's what you call retirement. Trying now to enjoy the best of your life, trying to keep healthy, trying to do things that are more impactful in terms of society and all these kind of things. So that is really the what you call the balance that one ideally has to achieve in life. But what has happened today is that people are living longer, so they're more active. And to a point about people retiring even at 70 or 80, because you still feel you have the energy. I mean, you've kept well all this first half of your life. You're healthy, you're mentally strong. So really, you don't feel that need to cap it. So I would probably define it that way: is that it's just trying to continue life, but in a more relaxed manner, trying to be more impactful to the society.
Yeah, the man who was here before you was born in 1945. He's still working as a judge at the UN. Right? So,
Lee's a very good example, actually.
Exactly. So City will welcome you with the day's proverb.
Okay.
And then we'll get into understanding what CPF is.
All right.
And the Taifa Pension Fund. Thank you. Good. City.
Yes, our proverbs for the whole of this week ending tomorrow, are from the Republic of Burundi. Three things decreases a person's intelligence.
It still sounds like three.
It sounds like 3 to me. But okay.
I'm not responsible for how you tune your
Say
hearing.
teach it, CT.
Free.
See?
Free. Not three.
Three.
But look, this is a democracy. So if you had to be 3, chief, carry on, sister. 3. It's good for you. So be it.
The best things come in 3s.
But yours is free.
It is free.
Okay. Yours is free.
But yours can be 3. Yes.
Vya bwerere. Sawa.
Ubwete.
Jeff, what's your interpretation of this? When they say free things do what, City? Come to those who eat.
No. Free things decreases a person's intelligence. Meaning, if you had intelligence, kiasi,
Yes.
free things come.
Yes.
It goes to almost 0.
This is what you do to us every morning. You give us 3 free sweets.
Yeah, and then now we just become like whatever. If you have 3 things in your head, okay.
Can you imagine? City gives us 3 free sweets every
day.
morning.
Yes.
Yeah. To just decrease our intelligence.
They are not free.
I kind of resonate with it. I mean, can you imagine if today we just woke up and found, I just said, let me have breakfast and pop, there it is. Let me do this, there it is. I mean, you'd not have time for engaging your mind to do anything because it's available. Yeah, so I totally agree with it. It's
which is necessarily not necessarily a bad thing, right? You need intelligence so that it can earn you things.
You two
now, if the things are earned,
Yes.
it's okay.
free is easy.
Free is fine.
So, it's a Burundian proverb.
Okay. What do you think the Burundians are saying here, Geoffrey?
Well,
is it caution not to give or not to accept free things?
I think they're challenging the people that you got to think. I mean, you think about it today. What is the one thing that Africans enjoy in this continent? It's the weather. The weather is so fine. I mean, you can wake up. You don't have to have heavy clothing. You don't have to have thermal vests. But in Europe at this time, they have to keep warm. They have to wear. I mean, thermal vests. Have you heard of thermal vests? If you go to Europe dressed like you are here, you die. Yes, but that creativity has been brought out by the challenges you face. So the free sun has made us a bit more relaxed. The adverse weather on the other side has given them the ability to think of solutions that can keep them, very warm. So I think it's quite a nice proverb. I've never heard it before, but I do think it's very relevant.
You connect, eh?
It applies, connects completely.
Very good.
Yes.
So you are Group Executive Advisor at CPF.
Yes.
Let's start by first understanding what is CPF.
Great. Thank you very much. So CPF is called, in full, it's a County Pension Fund group. But we've abbreviated it CPF because we have so many other businesses to do. Now, this company was created by pension funds. Now, just for a bit of history, so CPF is a baby of the oldest pension fund in Kenya called Lap Trust Pension Scheme. Now, Lap Trust Pension Scheme was the scheme for local authority officers, established in 1929. And it has been there since, and now it's a closed scheme, but still providing benefits to retirees. Now, over time, especially after the 2010 Constitution, we came up with a new fund called the County Pension Fund. This is because now we moved from local authorities into counties. So we have a second fund called the County Pension Fund, and it is now the fund for employees of counties. So Laptos was for officers. We still have some officers who had served before, so the past benefits are there, but the active employees are now members of what you call the County Pension Fund. And this is it's an umbrella fund for the entire 47 counties in the country. So they contribute to it. Within the County Pension Fund, we created a sub-fund called the Sali Pension Fund, and this is for our Islamic brothers. So it has got a unique structure. It complies with the Sharia laws, but it's for the Muslim fraternity. And so you find majority of the members of Sali are our northern Kenya counties and the coast. So we had to create that opportunity for them. We then have another fund called the Mwamba Trust Fund. Mwamba Trust Fund is a trust fund for benefits for deceased persons, because we felt that when somebody is deceased and we have got all these benefits to pay out, sometimes a huge amount of money, and you want to make sure that the beneficiaries are protected. Most of the time are minors. And so we created that fund. We also have an individual pension fund, an IPP fund, and now we have the Taifa Pension Fund, which is a unique fund covering the entire Kenyan populace. This fund is open to small, medium, large employers who do not necessarily want to set up their own schemes, but want to be in a formal scheme. So we've created an umbrella scheme called the Taifa Pension Fund. The Taifa Pension Fund, right? So it's a large scheme
all under this
group. Yes. So all those pension funds then created CPF Financial Services, which is a fund administrator, because Now, as under the Retirement Benefits Authority regulations, trustees who are the legal owners of schemes cannot be the same people running the operations of a scheme. So you have to give some delegated powers to a specialist in function. You can either do it as an internal administrator, or you can externalize it to a professional administrator. So in this case, the funds decided to create an internal administrator, but they did that in form of a company called the CPF
Financial Services.
Now, because our funds are involved in many spheres of business, they're in property development, they're in IT, they've got all these services, they need insurance, we decided to spin off departments within CPF into companies. So CPF now has 7 subsidiaries which serve pension funds, but we've also gone to other third-party clients. So today we have a subsidiary dealing with insurance brokerage called LIB, Laser Insurance Brokers. We have a subsidiary that handles property called Laser Property. We have a subsidiary that does investments called CPF Asset Managers, a subsidiary that does payment solutions called Rukisha, a subsidiary that does advisory services called CPF Capital, and then we have a subsidiary that does administration called CPF Financial Services. So they're all part of now CPF Group.
Boss.
Yes.
Wow.
This is a conglomerate. How much money are we talking about?
So within
properly under administration now by CPF Financial Services, and then just money that is floating within CPF Group.
No money is floating. It's optimized.
Okay. How much money is optimized?
So the CPF Group currently has 220 billion under administration.
220
billion under administration. Right. And I mentioned to you that we have our own captive funds.
Yep.
The five that I've mentioned, and then we also have non-captive clients. So today we are the administrators for the largest or the fastest growing pension scheme, which is a public service superannuation fund. So that plus our own funds gives us about 220 billion, and we're also the company that's going to be managing the Hustler component, the pension component of the Hustler fund. So you're talking about another 7 odd million people coming into that particular arrangement. So in aggregate, we are quite a phenomenal institution when it comes to the retirement benefits sector.
How many people do you, when you talk about now, how many people are contributing to this? How many people are actually touched by the CPF Group?
In terms of the numbers,
you've talked about the 7 million hustlers.
7
plus the civil servants.
Oh yeah, civil servants. That's another significant number. 450,000 county workers. So I would put an aggregate of close to 10 million people will be touched by or be impacted on by CPF, the group company.
Okay.
In terms of what they do. Yeah.
So, we know, it's, okay, maybe not to detail, but at least we have an idea, the mapping of how this, works big and then comes in, at whatever micro level. So how does this work exactly?
Right.
Who does what and puts funds away where so that you can, have access to them later? Give us the nitty-gritty of how this all works.
Great. So the structure of a pension fund is as follows. So an employer creates a fund, or rather promotes a fund. They're called the sponsors. Okay. Right word of a sponsor, as defined in the dictionary. So the sponsors. So the sponsors are the ones who create the fund. Now, when you create a fund, you must identify trustees, because a fund is set up under something called an irrevocable trust. So it's like a corporate entity. So it can't be as part of the company. It has to be separate. It has to be a delegated function. So you appoint trustees who become the legal owners of the scheme. So the trustees then sign into what they call a trust deed.
Excuse me, Jeff.
Yes.
You have introduced the word scheme into a fund.
The fund and the scheme, the same thing.
Okay.
Right.
Okay. Interchangeable.
Interchangeable.
All right.
Okay.
So the trustees are the ones who then establish something called the trust deed, which is the one that now is a governing or a constituting document of the fund. It's like the memorandum and articles of a company.
Okay.
So that trust deed is what spells out what the role of the trustees are. It spells out what the how the scheme will be run. It's really the one that governs the operations of the scheme. In fact, it's called trust deed, and the second part is called rules. Just like you can have the memorandum and the articles.
Okay.
So that's how it's structured. Now, once you set up the fund, you then have to appoint service providers to help run the fund. You must appoint an administrator, like ourselves,
Yes.
who carry out the entire operations of the fund in terms of receipting benefits,
Record
keeping records, accounting, payment of the benefits. All that is done by the administrator. You then have to appoint a fund manager who is an investment specialist. Their work is to invest that money.
Right.
The administrator cannot invest the money. The administrator
And cannot be the same.
cannot be the same institution.
Okay.
And then the third party that you have is a custodian where the money is kept.
Okay.
Now, these are normally banking institutions, so they are the ones who keep the money. So how it works is that when the money is when you as a promoter or sponsor send the payroll, the pension payments, you submit those pension payments. That money is sent to a custodian,
Okay.
and then you submit a parallel record of the contributors of that money to the administrator.
Right.
I just wanted to ask something in here.
Yes.
Because these are pension funds,
Yes.
essentially it is what the employer is going to pony up and say it's 10%, whatever,
Yeah.
and that you as an individual either match
Yes.
or surpass should you want to. Those are the funds that we're talking about that are going here.
Those are the funds we're talking about.
Okay, fine.
So there's a deduction from your gross
Yes.
towards contributing to the pension, say 5%.
Yeah.
And the employer matches,
Yes.
or even enhances.
Yeah.
Normally there are those options available.
Okay.
So
Please.
though that money is transmitted to the custodian account, which is like your bank account, but a record of contributors is sent to the administrator, and then that's where it rests, and then the fund manager is given sight that X amount of money is lying in the account. Do something about it.
Invest it.
So that's how they work. So the fund managers look for the opportunities, instruct the custodians. Oh, I've seen this bond. I've given instruction to buy it. Please settle. And then the custodian keeps a record of the contribution of the asset. At the end of every quarter, you report back to the trustees. What did the fund manager do? What are the investments you undertook? What's the return? The custodian should confirm. These are the activities and these are the assets we're holding. The administrator says, these were the contributions that we received. This is how each member owns in terms of contribution.
Yeah.
And generally all the other governance issues, compliance, etc. So that's how it does it. Very efficient. Since 2000, when the RBA regulations came into force, I think we have really built an exciting industry, very well structured. And
So now the risk of money getting lost because you one guy did what is now, in fact, eradicated.
Yeah,
because of this structure of our
checks and
retirement
balances.
benefits.
Yeah, the checks and balances.
So CPF Financial Services is a what? Administrator, manager, or custodian?
So we are an administrator primarily
Yes.
of pension funds.
Okay.
But I mentioned that within our group of companies, we have an asset management company.
Yes.
However, it only provides investment services for retail investors who want to invest in other products in the market.
Okay.
So it's more like a high net worth kind of business. But in the long run, they'll also be able to manage pension schemes, but they can't manage a scheme being administered by CPF.
Geoffrey Odundo is the Group Executive Advisor at CPF. We are today talking about retirement planning and why you should consider and think about retirement planning. There are many people who just look at their payslip, pension imekatwa. Pension imekatwa. You don't think beyond that.
Yes.
You're told, we're looking for trustees. Why do I want to be part of the trustees of this? No, you're because the employer. Why we should think about all these conversations. Are you thinking of retirement and how are you doing with your retirement planning? Geoffrey Odundo, Group Executive Advisor at CPF, is our guest. And we're talking about Taifa Pension Fund now, Jeff. What is it?
So the Taifa Pension Fund came out of the need that today the coverage of Kenyans in or any form of pension is quite low. The RBS statistics, or Retirement Benefits Authority statistics, latest statistics, say that only 26% of Kenyans are covered into some form of retirement. Now, what is the risk? The risk here is that you're going to be, in the future, you're going to have what you call old age poverty. Because you're going to have a large populace of Kenyans, and now approximately today, 74% of those without any form of income at retirement. That brings pressure on governments to deal with the issues of social protection. It brings, it slows down economic development. It has serious macro effects. So as an organization that is very connected to the economy and very, very keen on eradicating this social risk, we thought through and said, how can we help every Kenyan embrace some form of savings for their retirement? So today, if you want to set up a scheme, first of all, the cost of setting one up, the complexity, the putting together all these players, it's ideally an organization that can do it. But what about you who has a member of staff in your house? So you've got a watchman, you've got a housekeeper, you've got all that. What's going to happen to them when they hit 50 or 60? We rarely think about that. And so at the end of the day, you've not done your social duty of ensuring protection in the future. So they'll always be coming for a handout, empathy, etc.
Jeff, how many of them stay with you up to the time when they're 50?
So, yeah, are they permanently employed? This
No.
Well,
By and large, they're casual laborers. If you look at just the turnover of that, by the way, let me just, the point you make is an extremely valid one.
Yes.
Okay? Insofar as you want to introduce them to something that will likely be of help to them.
Yes.
Given that they're actually minimum wage earners.
Yeah.
Yes. Now, please continue. How do you incorporate them?
But you have a civic duty, even at the very outset, to ensure that even if they left you 50 years from today, they will always remember that you give them a protection in their life, because we want to create a society of people who are very aware of ensuring that they protect themselves. So just back to that. So the Taifa pension scheme wants to bring in all these people. So CT today, you can be able, under Taifa, you can be able to enroll your employees into this scheme. You as the employer will just sign something called a deed of adherence. A deed of adherence is like a document where you say, I want to adhere to this scheme. I want to adhere to all the rules. I want to adhere to all the regulations. So your employees, the 2 or 3 employees, automatically then become contributors to this scheme. So you just make sure that your deduction, maybe you top up for them a bit, but now they get into that discipline of savings. Okay? So that is what you're trying to achieve here. So it's a scheme open to everybody, small, medium, large.
Even individuals.
Even individuals. Now, large employers today, for instance, for you to set up a scheme, you have to put together that structure. Now, that's not your core business.
Yeah.
You can imagine appointing HR, appointing all these people.
You call them trustees.
You carry the risk of everything. Why don't you delegate all that to somebody else to do it? And so the Taifa pension scheme has a corporate trustee and all the service providers in place, and the structure sits.
Excuse me, teacher.
Yeah.
So let's say a company, let's say the Standard Group, PLC, right? So it does not want to deal with those issues of, trustee here, trustee there, but then it just wants to deal with knowing that Taifa Pension Fund is managing it.
Correct.
But then it also knows that Taifa Pension Fund is dealing with Standard Group, is dealing with all many other companies. In terms of the welfare of the staff at Standard Group, how does the group ensure that the welfare of its staff are actually being taken care of by Taifa Pension?
So within Taifa Pension Fund, the various policies that we have put in place. For instance, the most important one is the investment policy. So in the investment policy, we have spelled out how will the monies be invested. So if you're a fund of very young people, we can take an aggressive approach, put your money into more aggressive investment opportunities because you've got time on your side. If you're a company of older people,
an aging population,
we can go for a moderate. Okay, we can go for a very highly conservative.
Yes.
If you're within that band, you go for more moderate. So it has got that flexibility in terms of the investment policy character.
True.
The other issue about is how then do you make sure that staff, the communication documents are available, membership benefit statements are available, contribution records are available. So all that is captured within the fund. It's managed. We've got a very comprehensive system, very digitized, that allow you, Eric, to look at your fund value anytime. And you can then decide, I think my employer is not giving enough attention to my fund. Let me top up. And that is the kind of thing that we're saying. So the fund is very, very comprehensively set. And now an additional feature that we have in this fund is what you call benefit wrappers. We have a wrapper that covers you and provides you with a last expense benefit, pays your shift if you want. It's called shift, right?
If you want.
Oh, sorry. No, you have to.
Okay.
So it provides disability benefits, insurance, group life benefits.
Yeah.
So it has got that wrapper embedded.
Oh, it's embedded
into the
so
fund.
it's not an extra cost.
No, it's not an extra cost. So it's all embedded in there. What happens is that when you contribute, we take certain small amounts and allocate to all those other comprehensive benefits.
Right.
At the end of the day, when something crystallizes, unfortunately, then you got a surety that something will be paid.
So that's
Hold on. Yeah, sorry, no. With the other schemes where an organization has set up its own scheme and then it's dealing with someone else, there's an internal structure that says, so internally this is our committee that is dealing with our pension issues, right? Yes. And then we have now those are the guys who are the administrators.
Yes.
So how do you work with that? Because maybe an organization such as this one, over 1,000 members of staff, right? And then you're putting all this money into Taifa Pension Fund. Maybe you want to have internally, you want to have some, view into what's happening with the fund on behalf of your 1,000 members of staff.
Yeah. So we absolutely don't eliminate the role of the promoter or the sponsor. You still have a role because the sponsors have to have sight of what's going in the fund. So you'll get your regular updates, regular quarterly statements out of the fund and what it's doing. What you're trying to do, Eric, is to get all this, I would not say...
Non-core.
Yeah, non-core, right, yeah. So that you can focus on what you do day to day. Don't put your HR staff to have a team looking at the operations of a fund. Delegate it to a separate specialist whose 100% day and night job is to manage pension funds. And that specialization is important in organizations if you want to be efficient, if you want to ensure it's well run. And you then hold somebody to account, which I think is something that's very, very beneficial. And I think that's the way industry should go. Yeah. Just to mention one more thing, this fund is what you call, it's also a contracted out scheme for NSSF benefits. So the government has introduced the 6% that you have to contribute to NSSF. Right now it's tied, it's going to eventually end up at 6%. Now that money goes directly to NSSF. Now for those who do not want that money to go to NSSF, you can transfer that benefit into this fund.
Okay.
So your extra amount, you just pay the minimum NSSF requirement, but the amount that was over and above can be transferred to this fund, and then you sort of supplement your additional money.
Let me just understand. Did you say I can transfer my NSF account to you?
No.
Nice try. Nice attempt, but no.
So there's a minimum. So there's a minimum amount that you contribute to NSF, but after the 6% increase, there's something they call Tier 2 contributions. So there are two contributions you make to NSSF. There's Tier 1.
There's a mandatory,
and Tier 2 additional. That Tier 2, the law allows you to transfer it to an existing pension fund. Now we as Taifa, we are eligible. We were the first contracted out pension funds which actually can manage that Tier 2. If you want, you can opt to remain with NSSF for that Tier 2, or you can actually transfer it to us.
Why I mentioned NSSF is this. Everything you said is, in my mind, clearly thought out, and you've thought of everything, meaning something happens to this lowly paid employee of mine.
Yes.
You've got this insurance that guarantees something happens, they're injured, they can be taken care of. This is beautiful because I actually haven't come across anything of this sort myself. But there's one little thing here. There's this thing of getting paid. You see? You put your money and all these things happen. What are the guarantees that when I want to get paid, I will get paid? Now, I'm talking about people who are in my age bracket. When can I get paid? After how long do I need to put money with you before I actually get paid?
Yes.
What do I need to consider?
Yes. So So the type of pension fund, of course, let me speak from the fact that maybe you're an employee of Standard and Standard has put your money into the umbrella scheme. Now, when you hit your retirement age, you'll be given options.
When I hit my retirement age.
Assuming it's 70.
Nice one.
So I've extrapolated a bit. So assuming it's 70.
Yeah, let's go on. Yes.
All right. So when you attain your retirement age, the scheme rules have specified that when you retire, these are the options. Number one, give me either refund of contributions with interest, which is a refund of contributions. Number two, take my contributions and now buy me a pension. You know when you retire, the options you can exercise. You're given flexibility.
I'm given flexibility.
Yeah. So the money that we're aggregating for you into this fund is to help you make a decision when you retire. Now, when you retire, you have an option to get the money back. You have an option to leave the money in and convert it into a pension, which now pays you a regular monthly income for the rest of your life. Okay? Mm-hmm. Those are the options. So that is a given. Upon attainment of that age, that option will be exercised. And that's the beauty of having a scheme that is private sector based, regulated, because there will be never an instance of your benefits being delayed. It'll be an automatic thing.
Right.
And working with a company like CPF, you can verify the track record of the current funds, the current pensioners. Do you know today CPF has actually got a monthly, or is it an annual, staff payroll of 3 billion shillings, which we continuously pay to our retirees. And they're very impressed. They even have an association of retirees. So that is a given. Now, the other benefits like group life, that happens when, in case you die, that's again automatic because it's an insured product. We take your premiums, we give it to an insurance company. So they definitely have to pay.
Okay.
Do you want to ask a question?
Oh, I think here we're talking about folks who are employed.
Yeah.
What happens to folks who might want to join and are not employed?
Yes.
Is there an opportunity for them?
Yes.
If they're not employed, they'll not retire.
This is the question. But you could be doing something actively today,
yes,
and at some point you will not be as active as you were.
Yes.
Essentially, that is retiring.
Yes.
So, is there space for them?
So as I said earlier, this scheme is open to all and sundry. Mm-hmm. It's open to whether you're in formal employment or informal employment. So you could set you up as a contributor, and then you contribute, and when you feel that you can't continue, you can exercise the options of withdrawal. Mm-hmm. We will refund your contributions. If you've hit 50, you can tell us, "Oh, I think I have some money. Please buy as a pension for the future of my life."
So you can do an individual scheme.
It's very optional. Yes,
okay.
It's very flexible, and that's why we thought let's put all these features so that we don't leave anybody out.
How old is this scheme?
We launched it. Was it last week? We launched it last week, but of course, it's been in the works for a while. Putting together, making sure we get all the documents. It's already running. We already have members of the contribution scheme, so we just formally launched it about a week ago.
Why I ask is because my mind goes to pension funds like, say, those who are in the railways. Painful to observe the suffering that these people have gone through. You contribute these things all your life, and suddenly you have assets, but somehow it's not working for you, and you have all these difficulties. If there is a pension fund that was situated within, say, a parastatal, because it's a government institution that are notorious for what I'm about to say. The scheme that you now advise, I'm trying to phrase this thing carefully. How would they advise such schemes, or what sort of advice, what sort of help would they give these schemes? Because it's not as though these schemes are absolutely skinflint. They do have resources, they do have means, but the problem is they're not liquid.
The governance over the many years
has ensured that there are so many problems here that even the benefits that are there are lost somewhere in all this.
Yeah.
Yes.
You know, one of the benefits of coming to CPF is because CPF has got a very a strong experience in managing pension funds. I mean, you're talking about, as I mentioned, 1929, a scheme that was operating then and is still alive today, and whose pensioners today are really well catered for. You know, one of the biggest challenges we have is that we do not, when we set up schemes, you don't set them up with clear and sound objectives. Let me give you an example. The rule of thumb says, when you retire, Eric, you're supposed to take all your retirement income, pension, rent, etc. That whole thing should actually be 60% of your final salary. So if your salary is 100,000, you need to earn.
Jeff, repeat that again, because this is it's a very important thing you've just said.
Yes.
And I start again.
So the rule of thumb, or what you want to call an adequate retirement income, should be 60% of your final salary, net of other expenses. So you have no loans, etc. But 60% is what you need, is what you call adequate income to keep you at your current level,
to maintain your lifestyle.
And I don't say 60% of your pension. I'm saying income. So income means pension, could be rent, could be farming. If you aggregate that, you should actually have 60% of that every month to keep your lifestyle stable. Because you see, when you retire, we don't want you to suddenly drop. Have you noticed? People retire and automatically things change.
When you say drop, you
change of lifestyle. Change of lifestyle. You get stressed.
Keep it cautious,
you can't meet your bills, etc.
Yeah.
It's a typical thing. It's a very typical thing.
Because you no longer have a source of income.
The same level
Yeah.
that you had, and so those shocks happen. Now, for the old schemes, and I'm also going to be careful what I say. I do not think. I think the schemes were set up, yes, but were they set up right? Did they even change with time to ensure that the employees at the end of the day carry that what you call adequate pension? What you're seeing in railways is what we call trivial pension. People are earning little monies that can't cater for their old age. Now, what a scheme like railways should have done is liquidate some of those assets into more aggressive investments, like now treasury bills and bonds, which can then allow them to enhance the pension of their payroll members. I speak because I've had the benefit. I was one of the first fund managers for the railway pension scheme, and we dealt with the issues of how to convert some of those assets into liquid form. I dealt with issues of sentimentalism. So you leave it with it.
You could say that the setup at that point was right.
It was right.
But the management going forward,
I think
is where now
the evolution needed to happen a bit faster so that it can happen. So now the beauty with CPF, when you bring your scheme here, we will not just accept your terms. We'll tell you, Eric, I think it's good you're setting up this scheme, but the pension you want to promise to your employees is trivial. Why don't you do A, B, C, D, or even talk to them to enhance a bit, and you enhance a bit to encourage them, so that they get used to it. And I can tell you, when they see those benefit statements every year growing, the interest to ensure that, and then you calculate and tell them what that will be as income if they continue at that pace, that will encourage them to continue savings.
Is a guarantee, Jeff, that at retirement I will get this in cash form?
Yeah,
because you can put it in a statement, but the statement, you people with books
and words
put in a statement there, but then it's all land.
At a time in the future, you liquidate.
Your pension is worth this much. Kumba is like a plot to
vested
beyond Mavuen.
That is the word is called a promise, which the trustees are obliged to ensure it works. There's no way, and that's the beauty why RBA is there, to ensure that the schemes are set aside and are running well, even for the schemes that are under insurance companies. Their assets are segregated. So the idea is to ensure that when you leave, your pension is paid, and it's paid in cash. Pension is never paid less than in other forms. I can say that with confidence, because when I left my first employer, I accessed my pension. So I do access a small pension, and it comes. In fact, it came today while I was waiting there. So I'm just saying.
I mean,
so proof of concept exists.
Somebody's asking about pension while in the diaspora.
Yes.
So how does Taifa Pension Fund? Is it possible for Taifa
Yes.
Pension Fund to actually deal with those in the diaspora?
Yes, it is. At CPF, we've got a very, as I said, the whole Taifa thing is digitized. So enrollment, everything, onboarding is easy. You can do it online. Now,
Where? On the taipapensionfund.com.
portal.
Right.
Yes. So when you do that, you enroll, you submit your KYC documents, we onboard you, and we're able then to give you a statement and continue running the scheme. So it's open to everybody. It's open here for locals, internationals, and very, very easy to onboard.
If you are with one employer,
Yeah.
and this employer has enrolled into Taifa Pension Fund, you go to another employer, and the employer is not in Taifa Pension Fund,
Yeah.
but they're deducting your contributions and all. What happens there?
So you can request them that I've got an existing scheme. Please channel my contributions to that scheme, to the Taifa Pension Fund. If they insist that you remain with them, then you can keep your Taifa Pension Fund. It doesn't close. It remains invested, it continues running, and you can then have a second one. But the ideal thing is that if you know, and that's what I say, the future of pension, I think employees should be given the flexibility of where they want their pensions to go. And so if I'm already in Taifa, just change my details and channel my contributions to Taifa, because already that's where my contributions are going. Yeah. So that fungibility is very necessary, and we've created that avenue for it to happen. Yeah.
Okay. Very quickly, you mentioned that, you know, in the unfortunate incident that someone does pass while their funds are still active, what happens to those funds?
So if you pass away while you're still active, first of all, if you have a group life, if you're part of Taifa, there'll be a group life benefit that will be payable immediately. I mean, last expense immediately. The group life benefits once you get the administration
Which is
document.
3 times your annual salary.
Yes, for a small premium. That's what people don't realize about group life. It's quite
something.
It's quite something, yeah. And then your pension benefits will then be paid according to your wishes, because within the documents you'll also select your beneficiaries. So the trustees will decide and say, oh yeah, so these are how they're going to distribute your assets. And please note, pension assets are normally not part of administrative assets. So these ones actually are paid according to your wishes.
Okay.
It's been a very good conversation. Please come again. Come again. You know, when you have someone who understands the stuff that they're telling you,
Yes.
it's easier to understand.
For sure.
Yeah. You know. Just finally, just to mention a few things. When you're planning for retirement, there are things that you need to know. You need to first make sure that you have a pension. You must make sure that you have something exciting to do.
Yeah.
You must make sure you have a medical cover. So under Taifa, we have got what you call post-retirement medical. So you must make sure you have a medical cover. And then you must make sure you're close to your friends, because the only call, and your family, because the only call that you get when you retire is from your wife. So it's good to keep those
Make sure
nuggets.
you have a wife.
Start with the wife. 'Cause clearly,
So part of retirement planning.
For that.
marry. If you have not
of
married,
I said
retirement
family and friends.
Geoffrey Odundo is the Group Executive Advisor at CPF. We'll be talking about retirement planning. So those 3 things: make sure that you have a pension, that you know you're contributing to a pension. Make sure that you have a spouse and you are in good relations. And the number
Medical.
3, and medical.
And do something exciting.
And have a plan.
This is the Situation Room, the only way to start your day.